Welcome to Cashflow Lab, your weekly deep dive into the shifting currents of global finance. Today, we're tackling, well, a really critical mission. We need to master the central economic reality of 2025. It's this year defined by what feels like a triple threat. Massive global debt, inflation that seems determined to stick around, and because of that, interest rates that are just much higher than we got used to.
Definitely not the near zero world anymore.
Not at all. And this whole environment, it's largely a result of, the huge spending during the pandemic, plus all the ongoing geopolitical stuff causing instability. It creates this really formidable challenge, but we think a navigable one for everyone, really, from central bankers figuring out policy right down to you managing your own household budget. So our goal here today isn't just to list the facts. We want to unpack this complexity, cut through the jargon if we can, and really distill the actionable knowledge you need.
Yeah, get to what actually matters.
Exactly. We want to show you where the big risks are hiding, systemically speaking, but also, and this is important, where strategic opportunities might be opening up in this, new landscape.
Right?
Because the cost of money, interest rates, it's not just some abstract thing for economists anymore.
No, it's very tangible now.
It really is. It's profoundly impacting the structure of our societies. Everything from, say, how much money a nation has for its education budget, we'll get into some stark examples later, right down to the number you see on your monthly credit card bill.
It connects the macro to the micro very directly.
It does. And if those huge national debt figures feel paralyzing, then the big question has to be, okay, where's the escape valve? Where do we go from here?
Okay, let's unpack this. That's absolutely the place to start. To really grasp the challenge, we first have to face the sheer scale of this global financial overhang. We're talking, according to the latest IF data, Institute of International Finance, global debt, and that's governments, companies, household, everything, hit an incredible $307 trillion by 2023.
$307 trillion. It's almost hard to conceptualize.
It is. It's a monumental figure, and it's the foundation, really, for every policy decision, every economic forecast we're seeing now.
And when we break down that number, the public sector part, government debt, that's where things really accelerated, didn't they?
Precisely. That $307 trillion is the total. But the public sector chunk government borrowing worldwide accounts for over $97 trillion of that.
97. Okay.
Yeah, roughly 30% of the whole pile. And the fastest growth, as you said, was during the pandemic.
Yeah.
Governments rolled out these massive and arguably necessary fiscal responses. Emergency health care, furlough schemes, business relief.
Right. Trying to keep things afloat.
Exactly. But the consequence of all that urgent borrowing is now pretty clear on national balance sheets. Many advanced economies, the U.S., several big Eurozone countries, they've seen their debt-to-GDP ratios jump way above 100%.
Which is historically very high.
Extremely high. Levels we haven't really seen since the post-World War II rebuilding era. It signals this profound structural change in government finances. It's not something policymakers can just easily unwind.
That really puts the speed of this interest rate reversal into perspective, doesn't it? Because we had, a decade after 2008 of almost artificially low, near-zero rates, quantitative easing.
The era of cheap money.
Right. And then the pandemic just seemed to break that whole equation. Suddenly, inflation wasn't just a possibility, it was back. And back with a vengeance.
That's the chain of causality we have to trace. Starting in 2021, inflation really took off. It peaked in 2022 at levels not seen in decades. And the drivers were, initially at least, pretty textbook. You had huge supply chain bottlenecks as the world tried to restart.
Everything got stuck.
Everything got stuck. Energy prices spiked, made worse by geopolitics. And critically, you had all this pent-up consumer demand hitting limited global capacity. Too much money chasing too few goods, essentially.
The classic definition.
Pretty much. And this absolutely forced the central bank's hands. Their response wasn't tentative, it was, frankly, aggressive and sudden. The U.S. Federal Reserve, really leading the charge, dramatically reversed course. They threw out, essentially, 2 decades of policy thinking and pushed the target rate from basically 0 to over 5% in just about 2 years.
That speed is what's fascinating, isn't it? The sheer velocity of that change.
It is. What's fascinating here is the speed. It was necessary, they argued, to regain credibility on inflation control. It effectively slammed the door shut on that whole post-2008 ultra-low rate period.
And of course, a rapid kind of violent shift like that doesn't land equally around the world. It immediately exposed this deep fault line, this fragile divide between the richer advanced economies and the developing world.
That's a critical point. Advanced economies, they'd benefited for years from that cheap credit, all that liquidity from quantitative easing. But emerging markets, EMs, they're now facing this brutal opposite scenario. They're grappling with extremely high borrowing costs, much tighter money, and just generally more vulnerability because their economies are often less diversified.
How does that mechanism work exactly? Why are they hit so much harder?
Well, a lot of it comes down to dollar dominance. When U.S. interest rates shoot up, capital tends to flow back towards the safety and higher yield of the U.S. dollar.
Right, the flight to safety.
Exactly. So you get capital flight out of emerging markets. This forces their central banks to hike their own rates, often very aggressively, just to try and stop their currencies from collapsing.
Which then chokes off their own domestic economy.
Precisely. It tightens local credit, makes borrowing expensive at home, and crucially, it weakens their currencies. That makes imports things like energy and food, which they often rely on, much more expensive in local terms.
And the real killer for EMs is often the debt itself being in dollars, isn't it? The currency mismatch.
That's the ultimate vulnerability trap. Many EMs took on a lot of dollar-denominated debt back when rates were low, and the dollar might have been weaker. Now, as their local currency falls against a strengthening dollar, the actual cost in their own currency of just servicing that dollar debt skyrockets.
So even if the loan amount hasn't changed.
Right. A 10% drop in their currency means they suddenly need 10% more local money just to make the same interest payment to foreign lenders. It can quickly become unsustainable.
You see this playing out in places like Argentina, Turkey.
Absolutely. Those are prime examples of countries that remain extremely vulnerable to this dynamic. It highlights the danger of that original sin, borrowing heavily in a foreign currency.
Okay, so the last couple of years were about the steep climb of interest rates. But the outlook for 2025, it seems, is more about them staying elevated. It's not just a pause before they head back down to zero.
That's the crucial message, filtering through financial markets and from policymakers. It's less about a temporary peak and more about adjusting to a potentially new, structurally higher level for rates.
A recalibration, basically.
Exactly. Think about the central banks, the Fed in the U.S., the ECB in Europe, the Bank of England. They're performing this incredibly delicate balancing act.
Walking a tightrope, yeah?
Absolutely. Their main focus is still wrestling inflation back down towards that magic 2% target. But they have to do it without completely killing economic growth, without triggering a really deep and painful recession.
So they've mostly signaled they're done hiking for now.
Right. A pause seems to be the consensus. But they remain incredibly cautious. They're watching the inflation data like hawks, wary of any signs it might be stickier or resurgent.
Which leads to this idea of a new normal for interest rates.
That's the phrase you hear a lot. The Bank for International Settlements, the BIS, often called the Central Bankers Bank, has been quite vocal about this. They've suggested that structurally higher rates, meaning rates significantly above those pre-pandemic averages, might just become the default setting for the foreseeable future.
So the zero rate party is definitely over.
It seems incompatible with their mandate to control inflation in the current world. And we need to look beyond just the immediate cyclical stuff like supply chains. There's this concept of the neutral rate of interest, sometimes called R star. It's the theoretical rate that keeps the economy balanced, not speeding up, not slowing down, with stable inflation.
And the argument is that this neutral rate itself has moved higher.
That's the thinking. Structural forces might be pushing it up. Things like deglobalization, which can be inflationary as supply chains reshore, higher defense spending globally, and the massive investment needed for the green energy transition. All these things potentially require a higher baseline interest rate just to keep inflation in check over the long run.
That's a really important insight for listeners, I think, because if that neutral rate, R star, is structurally higher, then even when the Fed or other central banks do start cutting rates eventually.
They won't cut them back to zero or anywhere near it.
Right. They'll likely settle at a higher resting point, maybe that 3–4% range that's being talked about for the U.S. Fed.
Exactly. That 3–4% range seems like a plausible landing zone for the U.S., maybe slightly lower in the Eurozone, given the more fragile state of their economic recovery, but still significantly higher than the floor we saw for so long.
A different world entirely from the 2010s.
A different paradigm for borrowing and investment, definitely.
Okay, let's pivot slightly to the inflation outlook itself. The crazy spikes of 2022 seem to be behind us, mostly. Advanced economies are generally forecast to moderate back towards that 2% goal, if supply chains behave and energy markets stay calm. But there's still a lot of uncertainty, isn't there? And the path down isn't smooth everywhere.
No, the moderation is definitely uneven, and volatility is still a major risk. You can't discount the geopolitical factors. Anything that disrupts major shipping routes or affects oil production, particularly in the Middle East, could cause sudden price spikes. That remains a primary source of unpredictability.
And Europe still has energy security worries.
Absolutely. Europe's energy security post the major disruption of Russian gas supplies is a longer-term structural issue they're still grappling with. That introduces an element of vulnerability to price shocks.
What about other factors keeping inflation sticky?
Well, think about the green transition itself. Shifting entire economies away from fossil fuels requires enormous upfront investment. New technologies, new infrastructure, new regulations. These things often have costs that can, at least temporarily, feed through into consumer prices.
So the path to stable 2% inflation isn't guaranteed.
It's certainly not straightforward. Managing all these crosscurrents makes the central bank's job incredibly difficult.
And if we look back at emerging markets, the inflation story there sounds even tougher and, frankly, more painful for ordinary people.
It absolutely is. EMs are generally expected to continue facing higher and stickier inflation. And it comes back to those fundamental vulnerabilities we talked about earlier.
The weak currencies, the import reliance.
Exactly. Persistent currency depreciation makes imports expensive, and many EMs rely heavily on imported energy and, crucially, food. Food inflation globally remains a huge challenge.
That seems particularly worrying.
It is. Food inflation is incredibly corrosive. It hits the poorest households the hardest, and it's being made worse by climate change disrupting agriculture, affecting crop yields, trade patterns, local supplies.
So while a U.S. consumer might see overall inflation coming down, people in many other parts of the world are still facing brutal price rises for basic necessities.
That's the harsh reality. It's not just an economic problem. It creates real risks for social stability, for poverty levels. It's a very different experience of inflation depending on where you live.
Okay, so all this macro complexity, the staggering debt, the cautious central banks trying to thread the needle, the persistent inflation keeping rates relatively high, it all eventually boils down to a price tag, a really big one. Which brings us, I think, to the most concrete, tangible impact of this high-rate environment, the soaring cost of actually servicing all that debt. And this is hitting governments and households at the same time.
This is precisely where the abstract economic data translates into real-world constraints. Constraints on quality of life, constraints on future growth potential. If we connect this to the bigger picture, the really alarming consequence, and one that maybe doesn't get enough headlines, is that these debt servicing costs, just the interest payments on government debt, are starting to rival or, in some cases, even exceed spending on critical public services in major economies.
That's the crowding out effect people talk about.
Yeah, exactly. It's the crowding out effect in stark reality. Money spent on interest payments is money that cannot be spent on healthcare, education, infrastructure, or anything else. It consumes resources that could otherwise be invested in the country's future.
And the U.S. case is pretty dramatic, right? With national debt now over $35 trillion.
It's staggering. The annual cost just to service that debt, the interest payments, is projected to blow past $1 trillion by 2025. $1 trillion a year.
Just on interest.
Just on interest. And to put that $1 trillion figure in context, forecasts suggest it could potentially outpace federal spending on huge programs like Medicaid, which provides health care for low-income Americans, and possibly even exceed spending on various children's services combined.
That seems politically explosive.
Think about the implications. A government potentially spending more just paying interest, largely to bondholders often seen as the financial elite, than it spends on health care for its most vulnerable citizens or investing in its children. That kind of trade-off feels inherently unstable, politically and socially, over the long term. It risks real fracture.
And the pressure must be even worse in countries that already had sky-high debt ratios before rates went up. I remember the Japan example being particularly jarring.
It's almost hard to believe. Japan has the world's highest government debt-to-GDP ratio, well over 250%. They now face a scenario where their debt servicing costs are projected to eclipse their entire national education budget.
Eclipse it.
By a factor of 5 times. 5 times the education budget, just going towards interest payments by 2025.
How is that even possible if their domestic interest rates have been so low?
It's driven by the rise in global interest rates, pushing up the yields on Japanese government bonds in the international market. Even if the Bank of Japan keeps domestic policy loose, the global environment forces their borrowing costs higher eventually.
5 times the education budget. I mean, that's a catastrophic disinvestment in their own future, isn't it?
Absolutely. Think about the long-term impact. You risk undermining national competitiveness a decade down the line because you literally couldn't afford to invest adequately in educating the next generation. Those funds were already earmarked for servicing past debts.
And Italy is facing a similar squeeze.
Italy's situation is also extremely concerning. Their public debt is massive, over $3 trillion. The projections show their debt servicing costs hitting around 4.5% of their entire GDP by 2025.
And how does that compare to their spending?
That 4.5% of GDP is roughly equivalent to their entire national education budget as well.
So, same situation as Japan, essentially, spending as much on interest as on schools.
Effectively, yes. And these aren't just numbers on a spreadsheet. This directly threatens the government's ability to fund essential services. People rely on infrastructure maintenance, healthcare quality, educational resources. It erodes the state's capacity to maintain social cohesion when basic needs feel underfunded because of interest payments.
It feels fundamentally unsustainable.
It does. Something eventually has to give in scenarios like these.
And this pressure cooker at the national level, it inevitably filters down to households, right? Because consumer debt seems to be mirroring this public sector crisis, especially in developed countries.
Absolutely. The strain is becoming very palpable at the household level, too. Look at the U.S. again. Total household debt hit a record $17.3 trillion by late 2023. That's mortgages, credit cards, auto loans, student loans.
Driven by what, mainly?
Increases across the board, really.
Yeah.
But the area causing immediate concern is unsecured debt, especially credit cards. Credit card debt alone topped $1 trillion in the U.S. in 2024.
Wow.
And here's the kicker. The average interest rate on credit card balances is now hovering somewhere in the low to mid 20% range.
20-something%.
Yeah. So these high interest rates are placing an immediate crushing burden on ordinary consumers who might be using cards just to maintain their standard of living, especially with inflation still eroding their purchasing power.
That rising cost of just carrying the debt, even if you don't borrow more, that's like a ticking time bomb for household budgets.
It really is. And this isn't just a U.S. problem. In Europe, total household debt in the Eurozone hit $7.4 trillion by mid-2024.
Where's the main stress point there? Mortgages.
Often, yes. Mortgage stress is a significant concern, and we really need to highlight the vulnerability of homeowners in countries where adjustable-rate mortgages, or ARMs, are much more common than fixed-rate ones. Think places like the Netherlands, Denmark, Spain, Portugal.
So unlike the U.S., where most people have fixed mortgages.
Exactly. In the U.S., the 30-year fixed mortgage is dominant. But in many European countries, ARMs that reset based on current market rates are far more prevalent. So imagine a family, say, in Copenhagen or Amsterdam, who bought a home in 2020 or 2021 when rates were near rock bottom, maybe 1%. As rates stay elevated, their mortgage resets, and suddenly their monthly payment jumps significantly. Maybe it even doubles within a couple of years. That's a massive immediate shock to their household budget.
And that directly cuts into their spending power.
Absolutely.
Yeah.
That sudden, sharp erosion of their real disposable income forces them to cut back on other spending, which is a key driver of the overall economy.
So the big risk factor here seems clear. You've got these sustained high rates, plus inflation is still eating away at real incomes. It means households are finding it harder and harder just to meet their obligations.
That's the core problem.
Which likely leads to higher default rates, right? On credit cards, maybe auto loans first, and then less consumer spending overall. And that feeds back into the whole economic picture, potentially causing more instability.
Precisely. The pressure becomes systemic. It hits the national balance sheets through higher government borrowing costs, and it hits individual family budgets through higher loan payments and defaults. It's a squeeze from both ends.
A global and granular problem, as you said earlier.
Yes, it touches every level.
Okay. That paints a pretty challenging picture. So let's shift gears. This brings us to the really crucial part of our deep dive today. Given this environment, huge debt, structurally higher rates, what can people actually do? What are the strategies, the opportunities for investors, for individuals to navigate this new terrain successfully?
Right. It's easy to feel overwhelmed by the macro picture.
Definitely. But you mentioned earlier, the only way out of a $307 trillion hole is probably through enterprise and innovation, which brings us to where private capital seems to be stepping in, maybe filling gaps governments can't afford to anymore.
That's a key theme emerging. We have to shift our mindset from just bracing for impact to actively seeking out strategies and, yes, opportunities. The old playbook might not work. Traditional safe havens, like just holding government bonds, might not give you the returns you need to actually beat inflation over time in this environment.
So being passive isn't really an option.
Less so than before, perhaps.
Yeah.
Strategic navigation is key. Here's where it gets really interesting. One of the biggest structural shifts happening, and it's highlighted in the source materials, is this incredible growth and increasing importance of private capital. And within that, essentially private credit.
Private credit. Can you unpack that a bit? What exactly is it?
Sure. Simply put, private credit is lending that happens outside the traditional banking system. It's debt financing provided directly by specialized investment funds, big insurance companies, pension funds, sovereign wealth funds. They lend directly to companies, often medium-sized ones.
So bypassing the banks. Why is that growing so much now?
Well, it's becoming this really essential alternative source of funding, especially as traditional banks might be pulling back on lending a bit because of tighter monetary policy or stricter regulations on their own capital. Private credit funds can step into that gap, and they often thrive in a higher rate world because they can offer their investors potentially higher returns, what's called a liquidity premium, for investing in debt that isn't as easily bought and sold as, say, a public bond.
So they fill a vacuum left by banks and can potentially offer better returns to investors willing to lock up capital longer.
That's the basic idea. They provide often crucial financing for companies that might struggle to get it from a bank right now, particularly in the middle market.
And the scale of this market is potentially huge. You mentioned Blackstone's estimate.
Yep, it's massive.
Yeah.
Blackstone, which is a major player in this space, estimates the global private credit market alone could grow to something like $25 trillion.
25 trillion.
Trillion.
Yeah.
That's a colossal pool of capital actively looking for places to invest, looking for returns, even in or maybe especially because of this high rate, somewhat volatile environment.
So where is that money actually flowing? Is it just general lending, or are there specific areas attracting this private capital?
It's definitely not random. The capital is quite targeted. It's flowing into sectors and areas that are seen as resilient to economic slowdowns, essential for modern life, or part of major technological shifts. Private capital firms are predicting increased deal activity in specific pockets.
Okay, so where should an active investor, maybe someone listening, be looking if they want to tap into some of this? What are the hot spots?
Well, first, real estate comes up, but with a really important distinction. It's not traditional commercial office space. That sector is facing serious challenges post-pandemic, with remote work and changing needs.
Right, lots of empty offices.
Exactly. Instead, private capital is heavily favoring what you might call defensive or essential real estate sectors, things like multifamily housing apartment buildings, because people always need somewhere to live, data centers, which are crucial infrastructure for the digital economy, and logistics facilities, warehouses tied to e-commerce.
Assets linked to fundamental needs or unstoppable trends.
Precisely. Second, a huge amount of focus is on technological infrastructure, specifically AI infrastructure.
Ah, the AI wave.
Yes. The foundational computing power, the specialized chips, the massive data storage needed to actually run all these AI models. This is seen as almost non-negotiable capital spending for companies across industries. It's somewhat insulated from normal economic cycles because it's seen as essential for future competitiveness.
So for an individual investor, how do they even access these kinds of deals? It's not like buying a stock.
No, it's different. But there are ways you can look into specialized investment funds or things like business development companies, BDCs, which are publicly traded firms that often engage in direct lending to middle market companies, sometimes focusing on these growth or infrastructure segments. It requires more research, but it's a way to potentially gain exposure.
Okay, so private enterprise is stepping up, funding these essential areas. This seems to link back to what you mentioned about governments needing private sector help, like discussed at the UK International Investment Summit.
It does. The clear message coming out is that governments, especially with their strained budgets, simply cannot address all the challenges or fund all the necessary investments alone anymore. They need partnership with the private sector. Private innovation, private capital, private management expertise are required to tackle the debt overhang and deliver the economic growth needed to eventually stabilize the situation.
So it's a combination of needing strategic management from governments and dynamism from the private sector.
That's the necessary formula. Public money alone won't fix it. You need that strategic fiscal discipline from government paired with the engine of private enterprise. And that idea of strategic discipline, of prudent management, it actually translates quite directly into personal financial strategy too.
How so?
Well, We could look at the lessons learned, interestingly, from international finance centers or IFCs, places like, say, Jersey or Guernsey or Luxembourg.
Okay, how are they relevant here?
While they operate in a specific niche, their recent experience, according to the sources, provides a kind of microcosm of financial resilience during this period of higher rates. The analysis suggests that IFCs with strong banking and fund administration sectors actually benefited quite a bit from elevated interest rates and the boom in private credit. Why? Because it drove more activity, more assets under management, more fee income, which in turn boosted their tax receipts.
Ah, so they capitalized on the very trends causing stress elsewhere.
To some extent, yes, they were well positioned. However, the crucial part is what they did next. They recognized that this boost in revenue might be temporary, linked to the current rate cycle. So the required strategy, the key lesson, was prudent fiscal management. They used the windfall not just for immediate spending, but to actively replenish their strategic reserves, their rainy day funds, and specific reserves set aside for things like climate change adaptation, preparing for future shocks and uncertainties.
Okay, I see the parallel now. For the listener, for us as individuals, how do we apply that prudent fiscal management concept from the IFCs to our own finances in this high-rate world?
It translates directly into building your own personal financial firewall against this macro instability.
Hmm.
It's about creating resilience.
So practical steps.
First, prioritize locking in borrowing costs. If you have significant debt, especially a mortgage, favoring fixed-rate options becomes much more important in a world where rates might stay structurally higher.
Right.
Minimize your exposure to that payment shock from adjustable rates we discussed earlier.
Makes sense. Lock it down if you can. What else?
Second, maintain elevated liquidity. That IFC concept of replenishing reserves. Apply it robustly to your own situation. This likely means holding a larger than usual cash buffer or keeping funds in very short-term, safe, high-yield instruments like money market funds. Having readily accessible cash is crucial to weather any unexpected volatility or income disruption without having to sell long-term investments at a bad time.
So a bigger emergency fund, essentially.
A bigger, more accessible emergency fund, yes. Third, consider assets that offer some inflation protection. While cash provides safety and liquidity, its value gets eroded by persistent inflation. So, for longer-term savings where appropriate, look at assets designed to hold their real value. Things like Treasury inflation-protected securities, TIPS in the U.S., or similar inflation-linked bonds elsewhere. They can help ensure your core savings aren't constantly losing purchasing power due to the very macroeconomic forces we've been detailing.
Okay, so fixed rates where possible, boost your cash reserves, and protect some capital from inflation. That sounds like building your own version of national debt stability at the household level.
That's a great way to put it. It's about controlling what you can control your own balance sheet to insulate yourself as much as possible from the larger, less predictable forces at play.
That's really powerful, actionable advice. It shifts the focus from just the macro problems to what you can actively manage. Leveraging the new environment, whether that's through careful investment choices in resilient sectors like those private capital targets, or just meticulous management of your own debt and savings.
Precisely. The road ahead in 2025 and beyond is undeniably going to remain challenging. We have this backdrop of record debt, elevated rates, and this constant balancing act between growth and inflation. But as the analysis suggests, opportunities do exist for active investment, for innovation, and definitely for building personal financial resilience. They belong to those who navigate carefully, strategically, and proactively.
We certainly covered a huge amount of ground today. We went from, the big structural shifts in global rates down to the really quite agonizing pressure we're seeing on national education budgets in places like Japan and Italy. And hopefully landed on some concrete, actionable insights about things like private credit investing and, crucially, the need for building those personal financial reserves.
Yeah, to try and synthesize the main takeaways. 2025 really represents this critical juncture. The global financial system is still adjusting, maybe settling into, a fundamentally higher cost of borrowing. The stress points are becoming clearer all the time. You see it in public spending, which is getting crowded out, starved by rising debt service costs. And you see it filtering down into household budgets, facing pressure from higher payments and potentially rising defaults, which dampens spending power.
It connects all the dots.
It does. And this systemic pressure, this squeeze, it raises a really important, maybe uncomfortable question, something for you, the listener, to really think about. Given this extreme and likely growing strain on public budgets in major economies, the U.S., Japan, Italy are prime examples with debt servicing consuming vast national resources. How will vital public investment fare over the next decade? I'm just about investment in things that don't necessarily generate immediate revenue, but are foundational for future prosperity. Education, basic infrastructure upkeep, preventative healthcare, scientific research.
Things that build long-term capacity.
Exactly. We have to understand that today's debt service burden directly translates into tomorrow's potential disinvestment in those crucial areas. It's a trade-off we're making, perhaps without fully realizing it. So the question becomes, what immediate proactive steps must we take today, both individually and perhaps collectively, to protect our own financial futures and maybe our community's futures against this persistent macro instability and its potential long-term consequences?
That pressure on future public services, that stark trade-off between servicing past debt and investing in tomorrow's potential, that's a really profound thought to end on. It brings the whole discussion back to fundamental choices about our future. Thank you so much for walking us through all of that complexity.
My pleasure. It's a critical topic.
It certainly is. And thank you, our listeners, for joining us for this deep dive into the 2025 economic landscape. We genuinely hope this discussion has provided some clarity and maybe some useful strategies for navigating the months and years ahead. If you found this deep dive useful, please do subscribe and follow Cashflow Lab. We'll be back with more crucial financial and economic insights designed to help you succeed. Until next time, stay strategic.